On today's show, we're going to deep dive into dividends, the taxes on dividends, and their credits. My name is Candace, and we will begin right now. If you are anything like me, you are absolutely in love with dividends. There is absolutely nothing like watching passive income roll in and then reinvest it to keep the snowball rolling. Capital gains are nice, but dividends just tend to be more reliable and more akin to a paycheck. However, how often does the government just let us keep free money? The answer to that may surprise you. In the case of Canadian dividends, if you are keeping them in a registered account like a TFSA, RRSP, RESP, or an RDSP, you are not paying taxes on them, which is awesome. Foreign dividends are also tax-free if you are holding them in an RRSP. The TFSA is not considered a registered account for foreign dividends, thus a 15% withholding fee would be charged on those dividends. One question I will usually get is why would anyone not be holding a dividend-producing stock outside of their registered accounts? That is a good question, and there are many reasons why someone would choose to keep a dividend stock in their personal account. The most obvious reason is that they have hit their cap in their registered accounts, thus there is no contribution room left. Another reason is that they may be swing trading that stock, which is a behavior you do not want to be doing in a registered account, as it is enough like day trading to get you in a little bit of hot water with the CRA. Typically, the foreign withholding tax rate is 15%, though there can be a few deviations from this rate, but they are pretty rare. What this means is that if an investment was going to pay you $100 for a dividend payout, the country of origin, let's just say the US, would keep 15% of that and would only give you $85. The good news is that you can recover most of that money by claiming the foreign tax credit, provided it is not in your TFSA, as this credit is only available for dividends held in non-registered accounts. So yes, that does mean that 15% withholding tax on American dividends in your TFSA is simply gone. That is the reason I keep my American dividend payers in my RRSP. It is much easier that way. Foreign dividend stocks held in your personal account will pay that 15% withholding tax, and the income they create is 100% taxable. They do not qualify for the federal dividend tax credit. They are not Canadian dividends. This leads us to the foreign tax credit. The goal of this credit is to reduce or eliminate double taxation of those foreign dividends. The foreign tax credit is 15% of net foreign dividends. So for American dividends, it eliminates the double taxation completely. For a country like Belize, which does not have a tax treaty with Canada, they charge a 25% withholding tax. Thus, the foreign tax credit would only save you 15%, meaning you still are double taxed on 10%. When it comes to Canadian dividends in your non-registered accounts, aka your personal account, we have the federal dividend tax credit. This is a fantastic credit that will save you some money. The rate of the credit differs for eligible and non-eligible Canadian dividends. Eligible dividends will be from public corporations, while non-eligible dividends are from non-public corporations. On your T5, it will specify if the dividends are eligible, so you don't have to worry too much about which are and are not eligible. The T5 will also gross up your dividend income at a rate of 38% for eligible and 15% for non-eligible dividends. This provides the total taxable dividends. This part is a little confusing, so let me drop an example on the board. If you had $100 of eligible dividends and $100 of non-eligible dividends, your taxable dividends would be $100 times 1.38, and then add to that $100 times 1.15, which gives us $253 in taxable dividend income. Now, we need to claim our credit. The credit exists so that we do not pay taxes on the grossed up amount, as that company already paid those taxes. So the eligible dividends get a credit of 15.0198%, while the non-eligible ones get 9.0301%. keep in mind, these are the numbers for your 2021 taxes. So next year, those numbers may very well change. Our eligible dividend of $100 was grossed up to $138, and if we take 15.0198% of that, we get a credit of $15.02, while the grossed up $115 gets a 9.0301% credit of $9.03. Thus, our total credit is $24.05. Now, you might at first glance be thinking, wait a holy banana bread minute. They grossed it up by $53 and then only gave us a credit of $24.05. How is that fair? The credit comes off the taxes owed. Thus, if you made $30K, your tax rate is about 17%. So you would only be paying $9 on that $53 gross up, which you then get a $24.05 credit, which means you get a small negative tax bonus. That is not too shabby. Of course, the more you make, the smaller that bonus becomes. Hopefully that does make sense. Luckily, your D5 should make this calculation for you, so if you're afraid of math, you may not have to do as much as we just did. There are exceptions in the form of income or investment trusts. These are companies that do not pay taxes before they pass the dividends on to you. A REIT or a simple income trust like EIT are great examples of these companies. Because they do not pay taxes, they do not qualify for the federal dividend tax credit, and as such, their dividends are 100% taxable unless you have them in a registered account. It really does make sense to keep companies such as these in your registered accounts. And of course, if that REIT is American, you want to be keeping that in your RRSP. As you can see, the taxes on dividends is fairly straightforward once you get past a little bit of math. And hopefully, most of you are only watching this to affirm that you were right to put those in your registered accounts. If you guys loved this video, be excited. There is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.